the corporates in the country are also now exposed to the foreign currency. So I think all these things put together will determine that what will be the course of action from now.
Well, bankers say nearly 30% of restructured accounts will fall into NPA, have already fallen into NPA. Do you think this is an underestimate, or do you think it will be as much as 50%?
No, I think the 30% itself is quite say elevated figures from what they used to be. You must have seen for a long time the average run rate of restructured account getting into the NPA category used to be around 14-15%. It has slightly inched up. So I think this is what the level is. But how they will pan out in the future, or what will be the because one trend is quite visible. The restructured account turning into NPA for March 2015 quarter, the quantum was much higher than what it was in the March 2014. So obviously trend was showing the elevation, but I think this is the level, and again what would happen going forward will again be dependent on all these and factors which I have just mentioned to you.
Sir, but much of the NPAs which have come is coming from the infrastructure sector. And if you remember, most of the infrastructure lending happened during the 2008-2013 period. And this was also the time the Reserve Bank relaxed its rules with regards to exposure to infrastructure borrowers. Now, IMF had raised alarms in its 2011-12 report, but it took 5-6 years for the Reserve Bank, that's now in 2015, to tighten its norms with regards to this exposure. So, apart from the economy, even the regulation has not been proactive enough to help the system contain losses?
I always say hindsight is a very beautiful thing. And with the hindsight, things can always be judged in a very different perspective. But going back, if we go back to 2008, what was the global scenario, at what point of time India was sitting, and having said all, whatever we have discussed, see, infra was a sunrise sector at that point of time. It was clearly in need of the country. There was a scope for expanding infra, and infra was capable of giving a real rate of return. See, there are two situations globally. There are countries where infra is being created for the sake of creation, so that the economy's momentum remains on. Obviously, a large part of this infra may not be able to provide a real rate of return which can serve the borrowing. But in Indian condition, the infra was the need, it was capable of providing a real rate of return. So I think that was the perspective of regulatory framework at that point of time. Is a different thing that in subsequent years quite a few unforeseen developments have taken place. Many policy related issues have come, which has resulted into time overrun in the projects. Time overrun translates into the cost overrun, and that is what we are looking at today. So there was a certain set of circumstances when a certain regulation was evolving. There is another set of circumstances which have emerged, and obviously regulation is quite sensitive to it and moving in that direction. But so I don't say that it would be fair to say that the regulation was not proactive.
But you think we could have tightened a little more earlier?
I think that the Reserve Bank has been taking a fair assessment of the evolving situation, and regulations are coming at the appropriate time.
Okay. The other big leeway that you've now given to the corporates and the banks is the 525 refinancing scheme. There is a concern that this scheme masks the extent of asset quality pain in the system. CRISIL says around 80,000 crores will be refinanced this year. Do you think that this is the case, that 525 could be another way of getting out of the pain that corporates are going through?
See, I think you would also agree with you that Reserve Bank of India can be accused of a variety of things, but it cannot be accused of colluding for suppressing a problem which is very much there. So first, let us remove this notion that that there is any such intention on the part of Reserve Bank of India. Let's understand the 525 scheme in the right perspective. Number one, what we are calling as 525 is a global best practice everywhere. In fact, it is only aimed to correct a situation which was really not addressed in a right framework. See, if you have a project which is a long-term project, which will be generating the cash flow over a period of say 20 or 25 years, and if the repayment of that is tried to be compressed in 8, 10 or 12 years, there is a mismatch. Now, all this could have still worked well if the economy would have been growing at double digit. Then all this, and I think the projections which were made when these projects were first conceived, that was the time when economy was almost touching the double digit growth, and so projections were reflecting that optimism, and accordingly all the cash flows were projected. Things have changed, that we all know. So this is only now matching a realistic cash flow with a realistic repayment schedule. Now 525 scheme is introduced with all the proper safeguards, checks and balances. Is not open that you just pick up any advance and put under 525. It is for a certain sector, it is for a certain size. There is a provision of the external experts validating the projection. So I think it is a pragmatic step. It is addressing the root cause of the problem, and it is carrying appropriate checks and balances.
So it does not mask the reality.
The scheme which we have introduced is not the purpose that it allows someone to mask the reality. If there are attempts to mask the reality, then there is a whole supervisory system and oversight system is there from Reserve Bank of India, which would certainly take care of it.
Okay, so the Reserve Bank is fully aware of the extent of NPA problem in the system.
We are. If you see the evolving regulation, I think this clearly reflects that there is a awareness. We are keeping track of the development and taking the appropriate policy responses.
The IMF had recently warned that around 37% of banks' total debt is under risk, and that banks don't have much cushion to absorb these losses. How serious is this risk?
See, there are two elements to it. Of course, I have also seen that as far as this 37% is concerned, this 37% is a calculation which is largely coming out from the interest coverage ratio of a number of borrowers. The fact that the lot of activities have taken place after 2008, also the fact that many of these are going through the time overrun and there is an element of cost overrun. So the point which is, if you look from the balance sheet perspective, it is a point where debt is sitting in the balance sheet, the interest cost is getting accrued, but the related expansion has not completed. The cash flow will start coming when the related expansion gets completed. So then there will be a different situation of the interest coverage ratio. If you see in isolation at this point of time, the level of debt and the interest which is being charged and the revenue which is coming, obviously there are regions to be vigilant about it. So I would say that yes, there is an element to be vigilant about it. But just exactly to translate it into it that 37% of book is going bad or it is bad, will be probably taking it to the another extreme. Yes, if I talk about the capital cushion, yes, there is a need to augment the capital level, particularly in the public sector banks. And this Reserve Bank of India has already been talking about from time to time that there would be a need of significant capital, not only to address the asset quality issues, but also going forward as we move into the Basel III regulations and various provisions start kicking in. So there is a need.
I'll come to the capital in a bit, but you've been collecting, RBI has been collecting data on banks' exposure to large corporates.
Right.
This repository of information that you have, what is the assessment of the data that you're making? Are you forcing banks to take decisions on these large borrowers?
See, this framework, which is popularly known as CRILC framework and the related JLF, it was essentially meant for that purpose only. The purpose was, if there is a problem, recognize it early. If you are multiple lenders, come together, take a view. If there is a resolution is needed, provide that resolution. If recovery action is needed, move for that recovery action. So the whole framework is designed for that. I would say it works both ways. It would be unfair to say that it was always that the borrowers were at fault. There are multiple instances where the borrowers suffered because there was no quick action on the part of bankers or a common agreement on the part of bankers. So in a sense, this forum is providing is addressing both the issues.
But how are you assessing this data? Is there some serious risk that banks are sitting on?
No, I see, ultimately whole thing is related to what I said in the beginning. There are, see, if we look at the trend of SMAs, so SMAs, yes, there are accounts which come into the SMAs, get out of it also. There will be few exposures which are constant in the SMA list. So this provides some valuable input. Now this system was put few months back. It took some time to stabilize. I would say it has stabilized to a large extent. But there is a need now to put more analytics around it, to have the more data crunching. I think it will take some time, but that is one direction in which we are working. So that the data which is generated from this system, the more analytics are available and they are put to good use for the trend spotting and taking the appropriate forward-looking action.
Let's come to willful defaulters. Time and again, RBI has raised voice against willful defaulters. You've already put forth a framework for recognizing fraud. But do you think banks themselves are reluctant in classifying these loan accounts as frauds? Or is the legal system coming down?
I think it is a bit of everything. Let's understand the flow. Something happens at the operating level where the account is sitting. Now the signals which are emanating beginning, in a very initial stage, it would be difficult to distinguish between an account coming under a stress or account getting fraudulent. There's a fact of matter. So it takes some time, delay between the various layers of administration within a bank to recognize. But yes, there had been delays. There had been delays for the variety of reasons. People try that, okay, if it's possible first to try to recover, or the requirement of provisioning. So we took notice of all these ground realities, and the framework which we have put now on the recognition of the fraudulent borrowers, I think is quite a comprehensive framework. It provides the timeline. Like in case of NPA, there is a SMA. In this, there is a category of RFA, red flag accounts. There is a timeline. Within that, you have to determine. Then you have to either be clear it is a fraud or is not a fraud. If it is fraud, then move accordingly.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.